Took a look at a deal yesterday, apartment building deal, and I wanted to go over this. This is the eight signs, the eight indicators that you have a good deal. Why is that important? Because most people, when you invest in a deal, they don't even know if they have a good deal. So you got to know this, right? So for Bell Capital, when we're looking at a deal to invest money in with myself, my investors, I have things that I look for specifically. So if you're a passive investor, you need to know what your guys are going to be investing in, and they got to have an idea of what that is. So I'm going to go over them with you, which are mines. And I got my trusty whiteboard today. And I'm going to keep it simple because your things to know whether you have a good deal to invest in should be simple all the time. Number one thing for me, yeah, where's that at? Number one, I'm going to label them because I'm trying to cut down on how big I write in paper. Is location. Number one, the location should sell itself. Now, yesterday I went to, it's a portfolio, it's a collection of properties, downtown San Diego, really great properties. The properties are great. The locations are meh. There were so many homeless people around in that area. Beautiful properties. It's a collection of properties, 400 plus units, it's like 450 something. But the homelessness in the downtown area right there makes me go, nah, I can't deal with it. I don't want to deal with the piss smell, even if the mayor is Todd Gloria or is gonna fix it. It don't matter because if you're gonna invest your money there and we're gonna be there for 7 to 10 years. Do I think that that's gonna be a problem? So when I think location, that's what I'm thinking about. Now, as another deal, when the location should sell itself. When I say Solana Beach, you should be like, ooh, that's nice. Or Del Mar near the track. Ooh, that's nice. That's another property. We like Otay Ranch, $1 billion developments going on in Otay Ranch. Beautiful. So the thought process when I think location, I'm not just thinking location, the street. I'm thinking the location itself should sell itself. It should command your attention and command millions of dollars. Number two, it should have cash flow, and that cash flow should be positive. Should be cash flow positive. That means the rents minus your expenses, it should cover the debt, and whatever's left over should be positive to us and our investors. So anytime I'm thinking through a deal, what makes a good deal? It's got to have cash flow, and it's got to be positive cash flow. If it doesn't have positive cash flow, not interested, because the cash flow is going to get you through economic storms, and you guys know what's coming. Elections happening, Trump wins, Harris wins, don't matter. You're going to need cash flow to sustain over whatever term that these people are going to be into. The government is going to continue to do its thing, and you need money during that time. Next, number three, this is the want stuff. This is probably more important to me than other people make more important to them. The bank has to want it. It has to be able to get debt. The debt market has to want it. Now, the debt market is not the best right now. As a matter of fact, I was talking to one of our lenders yesterday, and we were talking about how right now, no matter what's going on in the world, the 10-year treasury went down a little bit and skyrocketed back up. I think today it's at 4.25. It's nuts. But all of these properties are controlled by the debt. But so that means that if you're a lender, if the bank doesn't want the deal you're looking at, it's not a good deal. Even if you're not going to use debt, which you always should use debt, at least a good portion, the bank has to want it. So if the bank don't want it, I don't want it. If the bank is like, we like the deal, Vic, it's a beautiful deal, but we'll give you money, but we're only going to lend you 40%. That means two things. The deal sucks, or the price sucks. The pricing is too high, or the income, it ain't there, which goes right back to cash flow. So the bank has to also want this deal. Number four, the manager. Look, you're not going to manage these deals yourself. We don't manage these deals ourselves. We manage the management company. We know we're going to have professional management on any asset that we take a look at. So if the managers don't want the deal, we don't want to deal with it, right? Great assets actually bring in great managers. So the managers have to want it. So the bank has to want it, has to bring in good debt, and turn that so you can see. And the management company that you bring on, like for us, we want to use Greystar for all of our assets. We know Greystar as a company itself is one of the largest multifamily owners in the world and one of the largest multifamily developers in the world because they come off the heels of property and asset management. So if they are not interested in the deal, which they have, I think, 24,000 apartments managed in this market that we look in by itself, not Orange County, just San Diego. They've probably already seen it. And that's why it helps to have the right deal, because if a manager wants it, great management, they're going to be like, hey, we love it. We don't mind managing it. We don't mind dealing with it. All right. So that's number 4. Number 5, the competition. I'll just put competition. They have to also want it. The competition means like, who's your future buyer? Is it a mom and pop? Is it a dentist? Is it some doctor? Is it 3 attorneys that got together because they have a little bit of money parked and they're like, hey, let's buy this deal? Or like myself, for us, when we look at who's the competition on the deal, it's institutional investors. It's EQR, it's KKR, it's Blackstone, it's KPI, KPI, no, FBI, right? Whatever. It's those guys. That's who the competition is on the deal. I want institutional investors to be competition on the deal, or they've actually owned the deal at some point in the past. Like one of the last deals we looked at was owned by an institutional investor. The deal I looked at yesterday, institutional investors. Another deal that I'm getting ready to go after because it came back to market, owned by an institutional investor. Your competition has to also want your deal. That's how you know if the deal's good. Who wants it later, right? Number 6, this is kind of a little bit off, but jobs. The jobs in the area. Job have to be going up, right? There has to be some type of income going on in the area. So jobs need to want to be there, stable jobs. If jobs are leaving that area, that's a problem, right? Because people leave, they go where their jobs are going to go. Even though people are like, yeah, I'm going to work an hour away and I'm going to drive. Odds are they're going to drive. And about 2 months, that shit's going to get bad. And they're going to be like, dude, I'm not doing this anymore. I'm going to go to my job and find out if I can get transferred, especially if they're high income people. High income people have employers who have multiple locations and or they can work remote. So it's important to know, hey, is there job stability in the area? That's how you know whether these are a sign that the deal that you're working on is a good deal, especially if you're going to be a passive investor in a deal. I'm always looking for that. Like I said, just because somebody has a great asset, it may be in an area where the jobs are not stable and it sucks. So you don't want to do that, which is why I like San Diego, Orange County, pushing off into Irvine, things like that, because the job market here is very solid. People are making a lot of money, and the job markets, they're not businesses are not leaving here. If they're here, they're here, all right, because of the money. Now, next, as it relates to the tenants, they need a stable income. Stable income. Now, I mark this to know that I got a good deal as I'm looking at a property this way. The tenants, I want to see somewhere around 27 to 30% of their income versus the rent. Again, this is the property manager that will be doing that. Or if it's not that, in the demographics of that area, I'd like to see that somewhere around 27 to 30% of their income and our rents. So if they make $100,000 a year, I'm $100,000 a year, 30% of that, $3,000 should go to their rent, somewhere in there. And our rent should be roughly about $3,000 a month or a little bit higher. But when I'm thinking through that, I'm like, hey, is there stable income from the people that are going to either be the tenants or the people that live specifically in that area? Like, for example, the Solana Beach property, people around there make about $150,000, $120,000 to $200,000 or more. What, probably more, right? Now the rents in that unit, that place, are somewhere around $2,700 to $3,600. So we already know it fits either the demographics of that area based on their household income, or their income of where they work at is going to be somewhere around 27 to 30%. So it is the same, but it is different because rents are different from how much money people make in a household. Could be 2 people, could be 1 person, but they're going to be renting an apartment. So that's important. And the last and probably the most important thing, and I'm going to show you on a separate piece of paper because I'm going through this fast. In a deal, the number one most important thing to know that you have a good deal, and it's the number one most important number, is the number of units. Because to be honest with you, here's the difference. Let's say you have a 200 unit deal, 200 times the rent increase. The rent increase. This is going to make sure that you make money on that deal. Your investors, how are you going to pay your investors? positive cash flow, all this other stuff. This is going to dictate. Now, this is only, let's say this was 4 units times however much the rent increases. It don't matter. It doesn't matter at all. So let's say on 200 units, let's say we have 200 units. Let's say we increase the rents by $100 times 200. That's 20,000 more, right? A month times 12 months. So we make an additional 240K, 240,000 a year on this deal, right? Which is 20,000 a month, 20,000 a month here, right? This right here, this is what, $400? Who cares? Right? $4,800 a year. Boom. That's what you're going to be making. It doesn't matter if one of these people move out, you're down. And it isn't going to be like 5%. It's going to be 25% vacancy on this if you lost that. Now, I can lose 10% of these people and have 20% vacant, 20 people gone, 20 vacant, and still do fine. Now, that said, this is what I'm saying. If you have a good deal. So let's say if you made an additional 240,000 divided by the cap rate, let's just say if you got it all, you ain't going to get it all, but let's say you did, divided by, let's just say a 5 cap. You would have made $4.8 million here just by raising the rents by $100. You wouldn't have made that here, guaranteed. It's not worth it. And what did I say over here? When you have a good management company, that management company, they're going to be the ones making that phone call, not you. The managers are going to call and raise that rent by $100. And that's important because of what? Now, I know 100% we're going to be making an additional $20K or $240,000 a year from that phone call from my property manager. But technically, what we're really making is $4.8 million. Now, write that. That is worth $4.8 million. I don't mind pushing my property management company to call everybody and say, hey, we're raising the rents $100. Me and the broker were talking about that yesterday. That's an easy call for me. Hey guys, get on the phone, call all the tenants over there because we're looking to make almost $5 million by raising the rents and making sure that happens. You ain't gonna want to call these people. Why? Because these people are gonna bounce. They're gonna lose tenants. If they go, what, $100, we're gone. It doesn't even matter if they're in the right neighborhood. You de-risk the deal by making sure the number of units, like I said, if you had 200 units, that's better. So all of these, how do you know you got a great deal? First location, cash flow, bank, managers. You want a good manager that wants that deal. The competition's got to want it. There's great job stability. Stable income for the people who would be living in that property. But the number one thing you're looking at to know that you have a great deal is going to be the number of units. So you guys know if you're investing with me at any point, or you're looking to do this on your own, whatever, think through those things all the time. And the number of units is going to be the most important, and the quality of the asset. Do not try to go and get a C-class property or a D-class property. D-class property, don't do it. C is just like complicated. It's complicated, man. It's gonna be a headache, complicated headache. Just stick to the B's and the A's if you're going to do that. We personally like A properties or B plus properties that we can turn into an A. That's important because we're long-term holders. But if you're going to do this on your own, trust me, number of units and all these other things I showed you, that is how you know you have a great deal. Or at least the factors of knowing you have a great deal. How do you know you have a great deal? So that's what I look for. I can tell you right off the bat, usually it's location. Number one thing I'm looking for, number of units, and then second, it's going to be location. And then I'm going to figure out cash flow and, the bank's going to want it or not, who's the competition on the deal, all that stuff that matters. But watch this video again. I went through it quick. It's important. It's probably the most important video I ever make about real estate because no one showed me this. I kept looking for the best deal in the worst location rather than look at the best deal at the best location and stop trying to be a bargain hunter and try to get the best deal because someone's going to want that deal for me. Someone's going to pay a premium later and I want it. And as long as it's got cash flow, I can hold it. And as long as the tenants that live there want to be in that area, I'm going to be good for me and my investors. That's how we make money. All right. So I hope this solves this question. What are the signs that I'm looking for? How do I know I got a great deal? It's less about how do I find a great deal. How do you know you have one even after you found one, right? Because who cares if you can find 1,000 deals because deals are everywhere. You can find deals everywhere, but how do you find a great deal, right? Those are the things that I look for. All right. So like this video, share it, comment on it. I know I go through stuff fast, man. But when I'm teaching, I kind of get excited. So share it, comment, subscribe. Love to hear from you. Give it a thumbs down if you hate it. Don't be a hater and a hider at the same time. And I want to grow my subscribers so I can share more information like this. Oh, and if you're interested in finding out more about what we do at Bell Capital, go to bell-capital.com. You got to be accredited. Got to have a good attitude. You got to love the idea of positive cash flow, great location, long-term investing with us. So that way you can be a part of our Bell Capital investor family. Love to have you. But we're here to answer your questions first. All right. So again, bell-capital.com. Hit the link there, schedule a call or get started, and then it'll take you to the portal, register, and one of us will reach out to you and answer any questions that you have. Have a great day today. Let's get after it. Boom.